Good morning, everybody, and welcome to this morning's webinar, which is about building business value. So my name is Will Abbott. I'm the head of the business advisory team at Randall and Payne. And our mission, if you like, our purpose is to help business owners leverage opportunities and build business value. And today's session really is to start investigating some of the issues that we're helping clients with and some of the things that we can bring in order to help you add value to the business. So I thought I'd start with some numbers because I'm an accountant, but I think these numbers are quite striking in terms of the impact. So if you were to increase the profit in your business by 50,000 in each of the next 3 years, that would add potentially around £1 million in value to your business. And I think what's striking about that is that the profit increase of 50,000, I think, is achievable for just about every business, and the return on that improvement is really, I think, quite significant. And it leads to the question: an extra £1 million on top of the existing value in your business, what sort of impact would that have on your future plans for yourselves, your family, the stakeholders and other people involved in the business? So I think it's just an interesting one to reflect on in terms of what we need to achieve to start building significant value in a business. So what we're going to cover today, 3 things, I think, really. Firstly, I think it's useful to start with just a bit of an explanation to lift understanding of business value and how businesses are valued. So we're talking about building business value. It's important to understand what that looks like, I think, for buyers. Second, then, is just to focus on 3 things that I think are really important in terms of value drivers. So some of the key things are just a way of looking at your business, analysing it against those 3 value drivers to see what you can do, what impact you can have, what areas need to be addressed. And then finally, we're going to go into a bit more detail about some of the things that we can do or you should be doing to drive value into the business. So hopefully those 3 topics are of interest, and so we'll run through those now. So understanding business value, this is where we want to start. And I think it's fair to say there's a lot of confusion, lots of misunderstanding around how businesses are valued. There's lots of stories about very large valuations of businesses, and I guess people will have various reasons for sharing their views of what businesses are worth or what they sold their businesses for. Trying to understand what that valuation, how that valuation was arrived at, I think, is an area that is really lots of people don't really have any kind of understanding of. So it seemed to me a good place to start. And this is the formula essentially that I work to, and this is the most common way of valuing trading businesses. And there are other ways, but this is the one typically that applies to the vast majority, and I think it's really the only one that we need to be concerned about. If you're in a very specialist area, there may be a different way of valuing your business, but for most of us, it's a future maintainable profit, a multiple of that. And there are rules in certain sectors, certain industries, where the multiple is actually a multiple of turnover as opposed to a multiple of profitability. But really, that's just a turnover. That's a profit multiple, just expressed in a slightly different way. For those industries, the buyers will be making some assumptions about the profitability, the standard profitability, the profits that they can achieve out of your turnover. So they're really paying that multiple of profit, but it's just been translated into a turnover multiple. So for me, this is how you value businesses. What does it mean? So the multiple is really defining the payback period. So if I pay 3 times your profit, I'm going to get my money back, provided your business continues to make that level of profit in 3 years' time. That's really what the multiple is. It's really important to understand that buyers are buying the future, they're not buying the past. So it's all about future maintainable profits. What profit is the business going to make next year and the year after and the year after that? And of course, one way to estimate that is to look at what profit the business has made historically. And I think that's where some confusion comes in then. And businesses essentially are valued, when we talk about sales post the transaction. We can often see what was paid, and we often know what profit the business was making. So, we get a lot of reference to historic profit, which I think causes some confusion. I think we need to be very clear and understand that the buyer is buying the future performance of the business. The historic profit is only an indicator of that. It's not what they're paying for. So it's not what's happened in the past, it's what could happen going forward. And in terms of future maintainable profit, it's good at this point to have some strong evidence to back up your claims of future profitability. So good, credible forecasts are important. Things that if you've done business plans in the past and been able to deliver on them, I think that's builds credibility of your plans for the future. So we need evidence, and as I said, the historic performance of the business will provide some evidence. The risk lies with the buyer, of course. So they are going to give you a lump sum of money, and they're going to get their money back out of future profits from the business. So they're taking the risk. Clearly, if they give you the money up front and the business doesn't perform, doesn't generate the profit they're anticipating, and they don't get their money back, or they get their money back over a longer period. So it is the buyer that's taking all the risk. That's why there's a lot of due diligence, a lot of questions to be asked, and a lot of things to answer. So the better you're able to answer the questions, the more information you're able to provide, the more assurance you provide the buyer, the more they get comfortable with the risk, and potentially the more they will pay. So what makes profit maintainable? A good management team is really important, and one of the key questions here is what happens when you step away from the business. If you're selling the business and you're looking to step away from it, who's going to replace you? So your role in the business, I think, is important, or how that role is going to be filled. One of the things we certainly encourage people to do is to build a strong management team that will continue with the business. What sort of market are you in? Are you in a growing market or a declining market? So again, if we're looking to maintain or improve profits going forward, a growing market is better than a declining one. Again, your products, are they up to date? Do you have new products? Are they obsolete? Are they innovative? Are they being bought now? What's the lifetime of those products? Are they going to run out over the next couple of years? Annuity contracts we talk about, so this is repeat income. So things like maintenance contracts, where we know there's a regular monthly income coming in, or even annual income tied to a contract. Anything that's contractual is more important, more valuable than something that's we've had customers for 20 years, but there's no contracts in place. So contracts with customers, things like that these all help the buyer to understand that the profit that's being generated, the sales that are being generated, will continue into the future. So those things are all important, and they have an impact on value. And then the profit element, of course, is about performance. How is the business performing, bottom line? So again, it's not necessarily about sales. Some people will be interested in your sales because they can bolt your business onto their existing business. That's certainly true. That's largely the valuation is around the profitability of the business. So is it productive? How productive is it? Is there room for improvement there? What's the sales growth been like over the last few years? Is there more potential to grow further? And a very important question, how much cash is being generated by the business? So as we know, profit and cash don't necessarily go hand in hand. So is the business cash generative? And the final element then is to think about the excess working capital. So as we know, in lots of SMEs, profits are made, that converts into cash, but the cash is left in the business. So typically, if there's excess cash on the balance sheet, that will be added to the price that the buyer pays. Fundamentally, the value is in the maintainable profit plus any surplus cash. So hopefully that gives you some kind of idea of the things that we need to be thinking about and how your business is going to be valued. So clearly, if you want to increase the value, we need to be looking at things like demonstrating that the profits are maintainable, making the profitability of the sales robust going forward, improving the profitability. These are the kind of things that will lead to improved multiples. Which leads me nicely into the second slide, which is about trying to achieve higher valuations. So I think if you talk to most accountants, as a rule of thumb, we would all say that 3 to 5 times is a sensible multiple. If you talk to some of the brokers, they would tell you that those multiples are quite low. But my view is that those are sensible and reasonable multiples. The question then becomes, how is it that businesses are sold for higher multiples? How you can have a £1 billion unicorn business that's valued at £1 billion that's never made a profit. And it's back to my point about future maintainable profits. So what the buyers are doing here, they're looking at a business. Let's say this business, year 3 now, it's generating a profit of 150,000. The line represents a multiple of 5 times, so the value of that business at that point is 750,000. What they're doing is looking at what that business can do going forward. Perhaps once they've acquired it, what else they can do with the business to drive growth. They're looking at how you're tracking in terms of profitability and growth. And if we say, let's say this business, this line now becomes a profit forecast for the business. So the business is forecasting over the next 2 to 3 years, it's going to get to 300,000 of profit. And using a multiple of 5 times, the value of that business in 3 years' time would be 1.5 million. So what happens is the buyer will acquire that business in the belief that it's going to be making 300,000 of profit in a couple of years' time. So they pay 1.5 million for the business. The accountants come along and say, you paid 1.5 million. The profit of that business at the moment is 150,000. So you've paid 10 times historic profit, which is absolutely right. That's exactly what's happened. They have paid 10 times the current level of profitability. What they've really done, though, when they've come to do their valuation and work out how valuable the business is, what they're prepared to pay for it, they've actually said, we'll pay 5 times the profit of 300,000 that we believe it's going to make. So that's just, I think, a simple explanation of why we hear about these higher multiples. I think it's about a standard multiple being applied to a higher future profit figure that's being anticipated. That is really all I wanted to say about valuations, just understanding what they are. I hope it's given you a flavour for it. Certainly, as an area that it's a bit of a dark art, I suppose. It's a bit of a mystery, and lots of people don't kind of understand these fundamental concepts. So hopefully that's given you a bit of a clue. So topic 2 then is just thinking about the key value drivers. And for me, I've broken these down into really 3 areas. The first one is having a very clear market and a product that serves that market. So I've called it product because I like to keep things simple. So number 1 is, what's your product? Is it an innovative product? Is there lots of growth? Are you in a growing market? Is there opportunities that we're going to make more money going forward? So a clear market and product and a solution to a problem is important. Secondly, is the team. We've touched on this before. So you do need a good, strong management team. And you need to be in a position to answer the question in terms of, what does this team look like when I leave? So what's your current role in the business? How important am I to the business? And how is that business going to be impacted if I sell and walk away? And then you do need some good, strong financials, whether that's profit or cash. This is what businesses are looking for, decent financial returns. As I said, they're taking the risk. They're going to pay money up front, so they need to know the business is going to be able to perform. I think at this point, it is worth reminding yourselves that you are probably the biggest investor in your business as it stands. So you need to think like an investor. So it's you're investing time, you're investing energy, you're investing your own money, you're retaining profit in the business to grow it. So you are probably the biggest investor in the business. So I think it's useful to think like an investor would think, and remind yourselves that you're not just running the business as an MD, part of the management team. If that's your role, you are actually an investor in the business, and you should be thinking about these things, because that's what buyers will be thinking about. So thinking a little bit more about the market, I think again, it's the questions I would be asking is, what market are you in, and is it a growth market or is it a market that's in decline? What's the competition like in that market? Are you a small fish in a big pond? Are you a significant player? Are you looking to win market share? What kind of margins are available in the market? So again, there's a bit of a trade-off here. If it's a high growth market with very attractive margins, it's likely that more competitors are going to come into that space. On the other hand, it might be a low growth market, so not very attractive to new competitors, but it might be decent margins in there, and it might be generating, throwing off decent amounts of cash. So understanding the market that you're in is important, and it certainly will be for the buyer. And within the market, have you got a particular niche that you serve well? So how is the market segmented? Is it geographical segmentation? Is it segmented along product lines? Is it demographics? How is the market segmented? And which of the segments are you operating in? And then specifically, what problem are you trying to fix in that market segment, and how does your solution match? How does the solution that you have match up to the problems being faced by that particular market segment? Which then brings us down to the third level, really, which is your sustainable competitive advantage. So what is your point of difference? How is it you're able to win? Why does your solution win? How is that solution protected? So is it something internal? Is it a product that's patented? Is it the skills and knowledge of the team? Is it particular experience that they have? Is it some particular capability that you have that other firms don't have? So what is it about you that makes the business different? How are you maintaining that difference through innovation, and how are you protecting your existing difference? So this is really about the customer, isn't it, and your product set. But understanding your market, that's what you need to know. So valuable businesses have a clear point of difference, operating in a defined market segment, solving a specific problem in a market that's growing. That's the kind of thing. Those are the valuable businesses, because those businesses are likely to be generating higher levels of maintainable profit going forward. So this one I just picked up from Harvard Innovation Lab. It's a model that's fairly well known, the Scott model, which is about value proposition. So I thought it was just worth sharing briefly, just answering the 5 questions. So you're taking your product. Which customers is it for? Who is it for? Why are they dissatisfied with the current product in the market? What's your product? What does it provide? What problem is it solving? And how is it different to the existing alternative? So the question we're trying to answer there is, how will your product win market share in a growing market? And it's easy, I think, to overlook the inertia of the existing market. So again, if you're bringing along a product which you think will be disruptive, have to recognize there's an awful lot of equity, time, energy, and money being invested into the existing product. So to remove an existing product from a market and replace it with yours is not a given. It's not straightforward. So again, it's something to think about. It's in terms of, are we really of an order of magnitude better than the existing product that we're really going to displace it and disrupt the market and win large market share? And of course, that does happen. But I think a lot of us are a bit over optimistic at times about what our product's going to do in the market. So it's really, really important to think about that. I think the second one that I encourage people to think about is resources. Excuse me, I'm going to take a drink. So looking at the resources. So if you think about maintainability of performance, if your machinery is wearing out, your factory is full to capacity, you have to start raising questions about how maintainable the profit is going forward. So we need to think about the resources within the business that's operating the business, manufacturing the product, delivering the product to the customer. I've just broken that down into these 3 areas. So people, your people in your business, are they capable? Do they have some particular expertise? And how are you going to retain that? Do they have capacity? Do we need more people going forward as we grow, or to maintain where we are? And I think the culture is important. It's a subject for another day, really, culture. But merging businesses, taking businesses and putting them together, there's a lot of issues around culture, different cultures from different businesses, and the challenges that generates. So you need to think about your resources, think about your people, their capability, their capacity, and what that needs to look like going forward. Then there's the physical resources. As I said, there's the factories, there's the offices. Are you bursting at the seams? Do you have 4 or 5 offices scattered around the country? Can is there an option to consolidate, bring it back to one base? What's the age profile of some of this machinery? So certainly on acquisitions we've been involved with, looking at the sort of the fundamental pieces of equipment that the business has and seeing whether there's investment needed to replace them. So on and so forth, and the IT, which is again important. So this isn't intended to cover all of them, but those are the 3 major ones. I think certainly IT is very high on the list nowadays in terms of business performance and likely future performance. Do we have all the resources we need, including the IT? And then what's the plan? What's the plan for the future needs of the business? What's the plan to replace the existing kit? And what's the plan to make sure that we're compliant with everything that we do, health and safety and all those other things? So thinking about the resources within the business. So we've talked about the market. That's what we're selling to. We've talked about the resources. This is the equipment and the kit and the people that we need to make those sales. And then the third piece, I think, of the value is the financials. So what's the result of all this hard work, if you like? If we're in a good market with good kit and good people, that should show in the numbers. So what do the numbers look like? What's the current performance of the business? What's the margins? Do we understand our margins across each of our product lines? Do we understand our margins across our customer base? So there will be, we've talked about this before, there will be customers that are generating more margin than others. There'll be some of our customers we're potentially losing money on, and the same with our products. So do we have a good understanding of that? Do we have the numbers to back it up? Can we demonstrate and show that to a buyer? In terms of forecast performance, what does that look like? Where does our sales go? How's our profitability being impacted? Where are the new sales going to come from? What investment will we be needing to make to achieve these sales? And I think fundamentally, in terms of credibility, how good are we at meeting our forecasts or beating our forecasts? So do we have consistently do planning? Do we do financial planning? Do we deliver on the results? So how's our performance against past budgets that we've set? Because that will give some kind of indication as to whether our forecasts for the future are credible or not. And then the sustainability, which again we've touched on. So do we have good annuity contracts in place? Do we have annuity income? So people are repeatedly, paying us monthly, paying us annually. They come back, they're tied in on contracts, possibly 2, 3, 4, 5 year contracts. So we know we've got some forward visibility of that income. We know there's going to be income because it's contractual, as opposed to just waiting for people to place orders with us. Is there a high concentration? So do we have 50% of our sales is with one customer, or 50% of our sales is with one product? Because that's risky, isn't it? If the customer decides to leave, or the product no longer becomes obsolete, that's a big part of the sales disappearing. So these things are areas that the buyer will want to look at and investigate when they're assessing the value of the business and what they're prepared to pay. So these are all areas that we can work on 2, 3, 4 years in advance of an exit, if that's what we want to do, in order to achieve greater value. But I think the other thing to say about all those things is back to my point about thinking of yourself as an investor. And one of the things I say, I think it's important to take from this is that you may not necessarily want to exit from your business in 3 to 5 years. You may not necessarily want to sell your business, but why wouldn't you build value anyway? Because all these things are important. You're an investor in your business. Why wouldn't you seek to improve its performance? If you can lift its performance, it becomes more valuable. Maybe the key thing is the performance. So I think this is why we need to think of ourselves as investors, because building a valuable business is just fundamentally about improving its performance. And if the business is improving performance and generating cash, that's a fantastic position for you as an investor to be in. So there's no preconception here. I think that this is all about selling our business. I think fundamentally we should be building value in our business, whether we intend to sell it or not, because we're investors. So down into the nitty-gritty then, in terms of coming back to that point about improving the performance of the business, how do we do that? And I think, again, there's 3 areas to cover. One is the people, one is the profit, and one is the growth. So just some thoughts on each of those areas, really. Recruitment and retention, people issues are the tricky ones in reality. Machines you can throw away and replace. People, needs a lot more time and energy. And I think we see people recruiting based on ability, based on aptitude, and there needs to be a balance between aptitude and attitude. So this is a chart that was put together by a colleague of mine just to explain how the aptitude and attitude concept works. And I suspect if I asked any client, they could tell me that there are good people in their organization, commercially strong people that consistently generate good results, but they're not very team oriented. They don't share information. They don't really work very well with other people. So they're kind of in the talented terror category. And those people are a problem. Those people are an issue. There's something there that needs to be resolved. And of course, it's quite tricky. If you think about people that don't have if we're a bit blunt about it and say people that with low aptitude and poor attitude, we kind of know what we need to do with them. People that are performing well in terms of numbers are quite tricky. It's harder for people to make decisions about those members of the team if they're essentially performing very well, but they're disruptive to the team. So again, one to think about, where do your people sit? And the reality is we've probably got a mix of people within most teams. It's just a question of whether we're prepared to tackle some of these issues, if you like, in order to build a stronger team and a stronger culture. This one, I think, it's an interesting one. It goes back a little while, 2005, but it's as true today as it was back then. And this is the cost, really, of recruitment. Having to people moving on, and I think as business owners, we intuitively know this is true. If somebody leaves, there's a period where productive, they're less productive. There's a period of time often when there's a vacancy that needs to be filled after somebody's left, and that's obviously zero productivity at that point. And then, of course, a new person coming in takes a bit of time to build up, get to know our systems and our people and our clients and how that works. It takes a little while to get them up to sort of their full productivity, if you like. So I think, again, that's one to reflect on in terms of retaining good people, retaining the right people, developing our people. Looks like a good alternative as opposed to going down the road of losing people. Perhaps they get disaffected and want to leave or whatever. So retention is an important thing, but it's also important to reflect on the comments I made earlier about whether people do really fit into the team and the culture. This one is really about if you're tackling a business, where we like to start is, the saying here is, don't put more business through an incapable system. So the structure of the business, getting the structure right is the important thing, getting the right people in the right places, getting the team structure right, sorting out roles and responsibilities, knowing who's accountable for doing what is typically the place to start, and that can take a couple of years to sort out, to be honest. The waste I'll come on to in a moment, but this is about then making the business more efficient, and finally the culture and the beliefs, if that needs to change, is the one that takes the longest. So this is a kind of a model in terms of business improvement stages, if you like, and it kind of, again, just reinforces the point that people are often trying to grow a business that's not really ready for growth yet, and the risk there is that you just end up breaking the business. So we do need to spend time getting these things sorted out before we really hit the growth buttons hard. In terms of efficiency and waste, so this is just the waste model, Toyota's 7 waste models. I'm sure some of you are familiar with it. Again, it's just a good one to go back and reflect on and use within the business to try and identify where inefficiencies are keeping in. So they're listed there. Overproduction, producing more earlier than we need to. Waiting for things to happen is a common one. Moving things around, transporting externally when we don't need to. Inappropriate processing is probably one of the most common ones I find. So the managing director, your small businesses, SME owners, you're just doing things, getting your hands dirty that really you shouldn't be doing. That's quite common. So just using people at a level above necessary to do the task. Holding unnecessary stock, work in progress, debtors, moving around internally unnecessarily, so lots of time wasted there. And probably one of the very common ones is defects, so doing things twice, 3 times to get it right, because often there's no process, there's no recorded process, or the right process hasn't been properly captured, so we just end up doing things 2 or 3 times. I think inappropriate processing, the defects, and probably the overproduction are the ones that I find very common. Waiting is another one. People just waiting for a client to do something, waiting for somebody else to do something. So those are areas to look at. We tend to, as a rule of thumb, we say 20% of the cost in your business is probably just waste. So we could be 20% more efficient, and that waste is literally wasted profit and wasted cash. So it's an area that it's not a one-off exercise. We should be looking at this continually. It's just a rolling program of trying to eliminate waste that's creeping into the business and efficiency. And this is a kind of model that we use where you go through the 7 areas, try and put some kind of a value on what it's costing the business, and then look at what could be easier to fix. So it's got high value and relatively easy to fix, then those are the sorts of things that we need to concentrate on. And again, a reminder at the bottom that if you don't fix these things will be costing you money year in, year out. And is it a way to improve profitability? Absolutely. And if it improves profitability and you apply that multiple, and it's adding multiples of value to the business, that's why it's important. So that's productivity, profit improvement. The next area really is about growing sales. And the question I like to ask people is, what would be the benefits to them if their business was to achieve 20% growth each year? And I get a mix of responses to that. The answer I'm looking for really is that to sustainably grow by 20% a year, you need a fairly efficient business and a good structure in place. So some of the things that we've talked about are absolutely necessary if you want to consistently achieve 20% growth. So the answer to the question really is what it forces you to become as a business. If you're determined to achieve 20% growth annually, then what you have to become as a business to achieve that is really very powerful. And of course, back to my point about future profitability, if the buyer can see that your profits are growing consistently year on year at 20%, then that forward projection of profitability that they're going to pay 5 times for, becomes incredibly important. How do we do this? There's lots of different ways. I'll just run through a few things, as ideas really. This model, we like the business model again. It starts really with the sustainable competitive advantage. We've talked about that before. How do you differentiate yourself? I've just given a couple of obvious examples. So Ryanair, we know, is a low-cost provider. British Airways, typically a premium service. So the business model for those two businesses is just completely different. So if you're not clear on what your sustainable competitive advantage is going to be, if you're going to be low cost or premium, then everything that flows out of that will not align. So with a clear SCA, that determines the marketing messages that you send out. And it also determines what the operations look like. And of course, then the innovation, human resources, and finance strategies all feed into that. So it's really so important to understand this differentiator. What makes us different? What stands us apart? What is our sustainable competitive advantage going to be? How are we going to win in the market? Be committed to that, because everything else about your business will need to align with that competitive advantage. One of the things that we suggest you do early on is just do some kind of audit diagnosis for each area of the business. So this example on the screen, we're looking at marketing sales. We've just done an audit. So we've looked at a number of factors, a number of questions we want to ask. We just rate ourselves on a scale. Are we poor? -5. Are we average? 0. Are we good? +5. And then give ourselves a rating where we are, where we think we need to be, and work out the gap. So the gap analysis really is to try and help you focus on the issues within this particular area, marketing sales, that need to be fixed first. So we'd encourage you to do this potentially on each of the areas above. What does the SCA look like? What does the marketing look like? Operations, HR, innovation, and finance, and just try and get a feel for where some of the issues are in the business and where you need to start. So it's easy, I think, to become overwhelmed with the number of things that need to be fixed, and it's just about having a plan. It's just about trying to understand where to start, what are the most important things, which are the ones that are going to have the biggest impact that we want to address first. So in this case, we can see we just picked out those 3 things based on the answers. And of course, you can do these audits with the teams. You don't need to do these audits yourselves. You can do these audits with the teams, although you just need to be slightly wary of turkeys voting for Christmas if the teams are rating themselves. Competitor analysis, I think, is always useful. I think it's easy in some cases to get too wound up by what competitors are doing, or become too involved with what competitors are doing. But we do need an awareness of where they are, and it's quite a useful measure. Again, looking at SCA potentially, how do we compare to our competitors? So the factors that we list here really about the customers, what's important to the customer is the first question. Identify 4, 5, 6 things, 6 factors that are important to the customer, and then try and give them some kind of a weighting. How important are they to the customer? And then work out how we compare to our other key competitors. And the purpose of this tool really is to start to identify some areas where you need to focus, which are the areas you need to focus on in order to be able to beat the competition. So again, it's a useful tool in terms of competition and customers. And then product life cycle, which again I think is one that may be familiar to you. Some of the terminology almost certainly will be. So what we know with most businesses is that they have a portfolio of products or services that they offer, and it's trying to understand what the future is for those products. So on this model, we're looking at business strength. So how good are you at delivering this product or service? And then how attractive is the market? Is it a growth market? Are there good margins in there? And the idea is that you plot each product on the chart to see where it sits. So interestingly, cash cows are a good product to have. Cash cow is a phrase I think quite a lot of people will be familiar with. The thing about cash cows is that it means that you're very good at them, you're very efficient, so you can deliver them with reasonable margins, but the market's not very attractive. It's probably, the classic example of this is cigarettes, which has been a cash cow for many years. Nobody really wants to build a factory to make cigarettes because the market is dying. So that means that the people that are already in the market, the competition for them is lower, which means they can maintain reasonable margins. So cash cows can be useful in that they generate cash, and what the cash cows are really doing is trying to fund the wildcat product. So these are the ones where these are really new products, innovative products, maybe products you're developing, maybe products coming into the market. So it looks like it could be an exciting market. It could be the next big thing, but nobody's really very good at it yet. So they're wildcats. We don't know whether they're going to become stars and cash cows or whether they're just going to fade. So there needs to be some investment in those, and some of them will turn into star products. So the buyers start to demand the product, the demand goes up, so it's a very attractive market. The margins start to go up. You get better at doing it because you become more efficient, and so it becomes a bit of a star product. The challenge there, of course, it is an attractive market. So what tends to happen with star products is that the margins start to reduce as more and more competitors pile in because the margins look so good. What that does do, of course, is forces the margins down, means the product moves into the cash cow category because now it starts to become less attractive for new players. But people that have got market share and established themselves there are the ones that will end up with the cash cows. So again, it's important to think about this. We talk about future sustainability, then we've talked about that a lot, future maintainable profit. So if you've got products that are no longer attractive, it's always slightly concerning that the products, the worst products, are called dogs. So if your product portfolio, and I have a golden retriever, which is interesting. So if your products are in that category, then the sustainability is in question, is really what I'm saying. If you've got products in the cash cow market, that's fine segment, but you need to be investing some of the cash that's being generated into new products because the cash cows will become dogs eventually. So if I was looking at this as a buyer and you just had a cash cow, it was a limited future lifespan and we weren't investing in new products, and I'd be concerned about that maintainable earnings going forward. So that's a product life cycle, definitely worth a review. And then the final one to look at is the business growth options. So again, this is a matrix really, just gives 4 ways to grow the business. So selling more of your existing products to your existing customers, that's probably the easiest place to start and the lowest risk. Market expansion, where we take our existing products that we know very well and try and move into new markets. So that might be geographical markets in a different part of the country, for example, or even internationally. That's market expansion. We know the product very well, but we don't know the new market so well. The other way around is where we try and sell a new product to our existing customers. So again, we know the customers very well, but it's a new product to us. So we don't know the product so well. So it's more risky, but it's a good strategy. And then the final option is diversification, where we decide to sell a new product into a new market. And clearly that carries more risk because we neither know the product nor the market when we start out at that point. So we tend to encourage people to look at the market penetration, market expansion, product expansion first. And as we all know, it's easier to sell to an existing customer than it is to win a new one, which is why really market penetration is where we want to start. That's just about winning market share for your existing products. So as we come to the end, there's a lot to think about. I think in terms of some of the detail around the stuff that we've just run through, the people stuff, the profitability, performance of the business. And actually, as I said earlier, it's about trying to get through that noise down to something that you want to focus on. So we use a one-page plan process typically, and we just encourage people to concentrate on 3 key strategies. So more than 3 strategies, they tend not to get done. So I'd say to people 3 strategies. What are they going to be in terms of improvement? Is it going to be sales growth in broad terms? And if so, which area? Diversification if you want. Is it going to be profit improvement? So looking at efficiencies and which areas do you want to start with? Can you improve the sales process? Can you improve the manufacturing process? So reflect on what we've talked about, go back through that, try and identify the 3 key strategies, summary of where the business is now, summary of where you want the business to be in 2 or 3 years' time. That should give you some clues as to the key strategies that you need to adopt, and actually take those strategies and turn them into action plans. So what's going to happen in the next 90 days? Who's going to be responsible for it? And one of the reasons we like the plan on a page is because it's easy to update. So we've seen many detailed business plans that gather dust in drawers. So a one-page plan, easy for everybody to understand, easy to be updated, easy to focus on what the key issues are and actually get some traction and some improvement. So just winding up, thank you for listening. I hope that's given you a flavour for some of the work that we help business owners with. Also give you some good clues, I think, into what business value looks like and how you can improve it, what some of the key value drivers are, big picture stuff in terms of where you need to focus, and then some more detailed granular thoughts about how you can build value, looking at profitability, etc. So thanks for taking the time to listen. We do offer a 30-minute advisory clinic. We always have done, but we do those now just to try and help you focus on some of these issues. So please do reach out, either ring or drop me an email. More than happy to sit down with you, just run through some questions and look at your business for 30 minutes to see the areas that you might like to think about focusing on, and indeed whether there's anything we can do to support and help you. So thanks for your time, and no doubt we shall catch up shortly.